Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash-flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club, and today we have Jeremy Goodrich with us. Jeremy is from Shine Insurance. He is an insurance master, and he is here to talk to us about risk management, which is something that we all need to really focus in on as real estate investors, because managing the downside is one of the things that really will actually bring the ROI to your investment. So I'm super excited to have you here, Jeremy. Thank you very much for hopping on the show.
Gabe, it's a pleasure. Excited to be here. Excited to open up the doors, pull back the curtains on the risk management insurance side. And while it's maybe a boring topic, it's, 5-6% of the revenue of most portfolios. So it's a real number that we've got to navigate.
I love it. Before we get there, I told you we like to start with stories. We like to hear how people got to where they are today. So why don't we take us back to the beginning of your story? How'd you get started in real estate?
So I was an elementary school teacher for 13 years. Loved doing that. Did it in Vermont and then here in Bloomington, Indiana. At some point, I kind of was done doing that. I had met my now wife and business partner, McKenzie. She was a third-generation insurance advisor. And so we both left our jobs. She left her dad's agency. I left teaching. And we started this insurance agency from scratch with the intention of changing the way people feel about insurance. It was like, we know people hate insurance. It's just like something that sucks. Maybe we can at least make it suck less, so not a very high bar, but,
I like it.
And so
good business model. Just make it suck less, and eventually people will
There's
come.
some things in the world, that's essentially what you're trying to do. If you just do your job and get it done, you're better than 90% of the other people. And so I was reading a marketing book by Jay Baer, and the concept was really understand your ideal client and then just do really good stuff for them. Just do good stuff for them. Doesn't matter about your product. If your product is a part of it, great. But, it doesn't have to be. And so I started thinking, and I was like, who's my ideal client? And that was really the first piece of the real estate world for me, because what I decided was, I really want to help first-time home buyers. It was like, I didn't know a ton about insurance. I was just jumping from being a teacher, but I like teaching people new things. So that made sense. And to make a long story short, over the course of the last 10 years, I've gone from teaching first-time home buyers, the entire process of buying a house, not just the insurance piece, but the entire process on our YouTube channel, to teaching people how to invest in residential real estate, 1 to 4 unit properties, whether those were flips or long-term holds or short-term holds. And then I moved about 4 or 5 years ago into really purely commercial real estate insurance and helping people to understand how to invest in commercial real estate. So for the last 10 years, it's always been the same model, which is find your ideal client and then teach them great stuff, do great stuff for them. For me, that's been our podcast. That's been our YouTube channel. That's just been trying to help people do better in the real estate world.
Nice, man. And that is, well, you're in the right area, because that's what we love to talk about here, especially commercial real estate. I have a soft spot in my heart for commercial. You said you like to teach people what they need to know about investing in real estate. So what is it that where does your message really hone in on? What are you trying to kind of get across to the investors out there?
I think the foundational idea is just how money works and how financial freedom works, right? We've got to have, in my opinion, unless you have money that you inherited somehow, you have to have 2 streams of income. One is active income, and the second is passive income. And the larger you can make the passive income pool, the quicker you can reach financial freedom, which, in my opinion, is simply, what are my expenses in a given period of time? Okay, can my passive income cover my expenses? That's the goal I'm working towards. And I think a lot of people who are working towards financial freedom. So what's the active income stream going to be? And what's the passive income stream going to be? For a lot of real estate investors, you start with, buying a single family home or buying a quad or buying, some kind of duplex and getting into the real estate world from that residential side and growing into a larger thing. For others, you're like, hey, let me be boots on the ground for a 200 unit deal. I know you're the sponsor. You find other people and bring them into your team and you get some active money coming in. and then you turn that passive. So foundationally, I think the insight that we're all trying to understand is how can we put those two things together to ultimately create a life where passive income is paying for our monthly expenses and providing financial freedom and location freedom and time freedom for us.
Yep, perfectly outlaid by Rich Dad Poor Dad, the original, the OG, the cash flow quadrant, all that stuff.
Right. Yeah.
Great, great message to get across. So let's talk a little bit about your bread and butter insurance risk management. I have gotten insurance policies on a ton of properties, and I still don't really know. I mean, I know generally what I should be asking, but I don't know. I feel like exactly what I need to be knowing. I feel like I should know more about the insurance world than I do. So when it comes to underwriting, especially from an insurance perspective, and getting an insurance package for your commercial property, what is it that investors should be looking for? I don't know. I can't.
Yeah.
I can't make the
Yeah.
question
No,
any better than that because I don't have
I
the
think that makes
knowledge.
sense. So I think you have to start one level above that. Insurance is a tool. It's all it is. It's a tool, right? What is it a tool for? Well, it's for limiting the risk. And so we have to take a level ahead and say, well, what is risk management in our commercial real estate endeavors? And risk management is every single time you make an informed decision instead of an uninformed decision. There are three different kinds of risk. One is things you can do something about. The second is things you can't do anything about. The third and the most dangerous are things you could have done something about if you had known they existed. Right. And so when we go through a due diligence process and acquisition, that's the entire thing we're doing is like, okay, what are the risks? What are the things we're trying to figure out? Which ones can we do something about? Okay, we've got a roof problem. We got to replace the roof. Okay, well, that's something we can do something about. Which ones can't we do anything about? Well, there's only one employer in this town and it's a military base. That may not be a good idea. That's a risk we can't do anything about. And then there's all the things you don't know about. And so you're trying to figure out how to put those into one of the first two categories. So I think if you're thinking about risk at that higher level, sometimes somehow it gets a lot more fun, right? It's like, okay, now it's just decision making and we're figuring it out. So where does insurance play? Well, insurance transfers risk to somebody else. It's sort of the beauty of it. Without insurance, none of us would be commercial real estate investors. Unless your listeners have tens of millions of dollars that are already in the bank that they can pay out, if a building burns down or someone sues them because they slipped and fell or whatever, none of us would be investors unless insurance existed, right? And so now it's okay. Well, now insurance has a purpose. It's just not just this thing I hate and I have to deal with, and the lender is telling me I have to get or I can't close the deal. It's actually a part of my process. And so inside of that is really where we start to get interested in, okay, what is this tool? How can I use it? Oh, I can pass on my entire building's exposure of $10 million, right? Or if I'm a larger investor, I have a whole bunch of capital. Maybe I want to hold on to $1 million deductible. I have clients who have $5 million deductibles, right? Now we're talking about holding on to a ton of risk, right? Most of your listeners are going to be like, no, I couldn't do a $5 million deductible. I don't have that capital. But if you've got 10,000 doors and you're saving $2.5 million a year on insurance premium by carrying a $5 million deductible, it starts to make sense to hold on a lot more of that risk. So I don't know if that was really where you were wanting me to go on that, but that lays the higher level foundation of what we're really talking about here.
Yeah. Yeah, my mind was just kind of like clicking away there, trying to figure out. I understand the risk management thing. I am curious more about like when you get an insurance policy, you have your general liability, you have your coverage for the actual structure, and then there's all these ancillaries like terrorism insurance, et cetera, et cetera, et cetera. What when someone goes to get insurance for their property, how do you generally coach them to decide on the coverage that they get? And I know that's a very difficult kind of thing to answer because it's very specific to a property and a metro and all that stuff. But do you generally suggest people get more insurance, less insurance, like in terms of coverage, based on the premium that they're going to have to pay? How do you coach them about the type of coverage that they should be asking for?
Yeah, so there's really only three main coverages that you want to think about when you're investing in real estate. The first one is coverage for your building. If your building burns down, the insurance coverage is going to provide the finances to rebuild it. The second one is loss of income coverage. If that building burns down and you had 16 units inside that building, well, you probably had $60,000-$70,000 a year of rental income that you were expecting. Now it's not going to be there. Your insurance policy, if you have loss of income coverage, is going to replace that lost income. Super important for your investors, for your lenders, for everybody who's expecting that income to come in. And then the third, as you mentioned, Gabe, is general liability coverage. If someone slips and falls, I got a claim that's happening right now. Someone slipped and fell on some ice out in front of a property. They broke their arm. It was $3,000 at the hospital, but now suddenly it's $65,000 because they found a personal injury attorney that was going to represent them, right? So that's general liability coverage. Those are the three basic coverages. Once you get into the weeds beyond that, like you said, it really depends on the property. Okay, do we want to insure the building to the entire replacement cost, or do we want to replace it, insure it for market value because we wouldn't ever actually replace it if it did burn down? Do we want to have a high deductible or a low deductible? That will affect the premium as well. Do we want to have something like terrorism coverage you just described was created after 9/11 to cover specifically terrorist acts? Do we feel like we need to pay for terrorism coverage? If yes, then we would purchase that. If not, then we wouldn't. So all of these different pieces, it's really the responsibility of your advisor to tell you about. I'll add one caveat, and that is if you've got a Freddie or Fannie loan, or most lenders really, they're going to have expectations of your coverage. So it's not just a conversation between you and your advisor. A lot of times the entity that has the most to lose is usually the lender. They have 80% of the property. And so the lender is going to have almost a stronger opinion than you do about what coverage you actually want.
Yeah, that's that's kind of the perspective that I'm coming at this from, because a lot of deals that I do, I negotiate seller financing. So I am, I'm working with the lender or with the buyer who becomes a lender, or even I've sold properties with my own seller financing. And I'm trying to understand better how to cover the properties with the insurance. So you mentioned those three different buckets: building, loss of income, general liability. Most things fall within there. When is the building coverage, does that include fire, flood, tornado, those kind of coverages? Is that additional that you should be asking when you're talking about coverage, or is that included within the building damage?
So the answer is it depends. So there's things that are covered. I mentioned those three things, and then there are bad things that happen that are covered, right? So an insurance policy doesn't just say, hey, if anything bad happens to your house or your property, then we're going to cover it. It's fairly specific in what it does cover, and more specifically, it says what it excludes, right? And so an insurance policy includes a lot of stuff that happens depending on the type of policy that it is, but it excludes a lot of things as well. Most common is flood, right? Natural rising water is excluded on almost every insurance policy. Homeowners, property owners, excluded. To have flood insurance coverage for natural rising of water, you have to purchase a flood policy either through a FEMA policy or through a private insurance company, just like any other way in type of coverage. So flood is excluded. Earthquake, oftentimes excluded, right? Wildfire, certainly excluded in California. You got to find your own policy for wildfire, right? Or, in areas that have high risk. So an insurance policy is a contract, just like when you create a contract for your tenants, or when you create a contract for your syndication investors, or whatever it is that you're creating contracts for. Insurance companies have different contracts. Now, insurance contracts are super standardized For the most part, you're going to see some very similar guts to every single insurance policy. But then what happens around the edges is, different for every insurance company. So the bottom line, and the most important thing any of your listeners can take out of this conversation, is really have a good insurance advisor, someone who's clear in the way they talk to you about things, someone who gets you and your approach to investing, someone who understands the market that your properties are in and how to find the best solutions for that, because it would be impossible for anyone to tell you every single thing about an insurance policy. So you really have to, lean on your advisors just like you do with the rest of your commercial real estate team.
Yep. Yeah, that makes a lot of sense. In terms of when an incident actually does happen, what should, the owner, the investor, what should you be doing to take the right steps in the insurance process, make sure that you have all the documentation that you need when the insurance company, requires whatever they require. So what are the steps that you generally recommend an owner take once an incident does occur?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
So I think obviously calling your insurance company and making the claim is a really important one. You want to do that sooner rather than later. There are clauses in insurance policies that say if you wait too long, and by too long, I mean like 6 months or something, or a year, that it could change coverage. But I think the most important thing that people don't understand about the claims process is that there are two parallel groups of people working through a claim together. One is your contractors, the people who are going to come in and dry out the place, going to clean up the fire or smoke damage, that are going to, rebuild the property. They're going to frame and drywall and do all the things. That is one side of the coin. Insurance companies are not contractors. They're not remediation companies. They don't come in and fix anything. Insurance companies have one purpose, and that is the money, right? They're financial endeavors. It's a financial relationship. And so sometimes we think we call the insurance company and they're going to send out contractors and they're going to, they're just going to take care of it. That is not the case. The insurance company is going to provide the financial side of it. And then the contractors and things of that nature are going to be parallel to them. Now, they should all be in communication and you should be the center of that communication. But I think that's an important piece. And then you just walk through the process. Again, trust your advisors. A good insurance advisor should have a great claim process and should be there. If you have an independent advisor like I am, I don't work for the insurance companies. And so I'm there if you're like, hey, Jeremy, this insurance company is not getting to me like they need to. Like, I'm going to jump in. I'm going to advocate. So I become your advocate.
Yeah, that makes sense too. I've had situations. I actually just went through an insurance claim recently due to vandalism at a property, like pretty severe to vandalism.
Yeah.
And when it comes to finding the right type of insurance, I know there's a bunch of different types of insurance companies out there, and there are also there's the advisors, and then there's the insurance companies themselves. How do you go about finding the right fit when you're out there shopping for insurance?
So I think it starts with those original conversations. I mean, it starts with a referral oftentimes, right? Like if you ask other commercial investors who they're working with and they say, oh, I've got a great advisor. Well, that's a pretty darn good start, and then you connect with that person and see if, again, they make sense in your relationship. Think about it like you would think about a property manager or an accountant or a lawyer. Like, would you just say, okay, yeah, go do your thing. How much is it going to be? Oh, that's way too expensive. Okay, I'm not going to work with you. And you also wouldn't ask 5 different lawyers to create a tenant lease and then compare them and only pay the one who you liked the least the best. Like, that doesn't make sense either. So I think that it's really going out and finding someone who you connect with. Independent advisors, they shop for you. In the commercial real estate world, once a company has been approached by an advisor, they're blocked. So no other agent can go to them and get a quote from them.
Interesting. Okay.
And so that's a really key piece too. So if you're going to shop multiple advisors, which isn't generally the best idea anyway, because a lot of us have the same company access, and a good commercial real estate advisor is going to have access to most of the good companies. If you are going to shop multiple advisors, pick the one you like the best and tell them first. Yeah. Because they're going to let them go block all the companies, because whoever you tell first, if they're good at what they do, they're going to go block all the companies, because it's a competitive world. You don't necessarily want anyone else to have access to any other company. You want to make those companies battle for the business of the person who has come to you. And so you're going to do that. So when you pit 3 or 4 agents against each other, it just doesn't actually work to your benefits. Companies actually see submissions even when they block them, and if they see multiple agents that are submitting to them, they're going to say, this investor is just shopping for the cheapest price, and they're not going to be the kind of person who's committed. There's some gaming that happens on the back end, if that makes sense.
Yeah. I always suggest people look for the cheapest price. I always ask, when I tell people to go out and they get a service, I always say get at least 3 quotes. But what I didn't know is that insurance agents, when you guys are getting quotes, you guys are going to the same companies. And once you ask that one company, they can no longer provide a quote for anyone else. That's pretty unique.
And what I want you to think about real quickly is that, if you have 3 advisors going out there and one person blocked all the good companies, the second person is not going to quit. They're not going to say, oh, well, I don't want to make this money. We make about 10 to 12% of your insurance premium. So those are decent numbers when you think about what your policy size are. So what are they going to do? They're going to go out to the crappy companies, because those crappy companies are going to get them a price that maybe can sell you the policy, and then they get the policy. So instead of buying a quality policy from a quality company that would have a good claims experience and probably would still be a pretty competitive price, you end up seeing numbers that are maybe a little bit lower, but are worthless pieces of paper. And, that is the big problem with when we do it this way and we go for the cheapest price. In the insurance world, it just doesn't work out the best.
Yeah, that makes sense. All right. Well, I love it. I just took a peek at the clock. It looks like we have run down the timer. So it's time to jump into the quick question round. Are you ready?
I am ready.
Let's do it. Starts with books. I'm a big bookie, so give me 2 recommendations. And if you're not in books, any form of education, YouTube channels, whatever, 2 recommendations, 1 for general life wisdom, 1 for real estate specific.
Well, Brian Burke's Hands Off Investor is great. Hunter Thompson's book about investing is awesome. Anthony Vicino put out a book recently about syndications and syndication investing that is pretty great. So those would be my real estate specific. Not real estate, man. I love Jay Baer. Jay Baer is all about marketing. If you're a business owner of any kind, all of his books, Talk Triggers, Hug Your Haters, Utility, all good books.
Cool. I love it. All right, moving on. And this is for your younger self. So let's go back to Jeremy, who was still an elementary school teacher. Go back to him, look him in the eye, give him 1 piece of advice moving forward.
Well, I think it comes back to the beginning of this conversation, whether it's just that idea that, look, you've got to understand money at a higher level. And I know you were a pastor's kid, and I know you're an elementary school teacher making $27,000 a year for 13 years in a row. So it's not real easy to understand financial freedom. But I think that if you can think about money at a little bit higher level, it's really going to help you to find that in the future.
Wow. I did not know. This is Indiana, the state of Indiana?
Yeah. Uh-huh.
I did not know they were paying $27,000. That's, I guess housing prices are a lot lower out there, but
they are lower, but still a lot of credit card debt got built up.
Yeah, for sure. All right, moving us on. This one is about the U.S. I know you are an LP investor, so you are a limited partner out there. You are investing in the market today. So if you could pick one metro that you're most excited about investing in, which one would that be?
I like the Midwest a lot. I'm biased. I live in the Midwest, of course. But I just think the stability is there, especially what we're seeing in 2023. People are getting enticed in other places, Texas being a big example of a place where investing is exciting and enticing, but really, really risky in a lot of ways. So Cincinnati is a metro that I really like. It's one I know pretty well. It's only a couple hours from me. Indianapolis, you got to know what part of Indianapolis, but I guess that's true of any metro. So, those would be two. I think you said one. So Cincinnati.
Okay, Cincinnati it is. Moving us on, and this one is about finding deals. It all starts with finding a good deal. So what is your favorite way to find your next LP deal to invest in?
LP deals. I mean, I'm fortunate in that I talk with investors all day, every day, multiple investors. So I see deals constantly. I'm underwriting them from the insurance perspective. But of course, it's not that different than underwriting them for an investment. So to me, the GP team is almost all that matters. I pay attention to the market. I pay attention to the deal. I pay attention to the numbers. But more than anything else, I want to know that it's a team I trust. It's a team that's done it before. It's a team that's shown success. It's a team that's gone through downsides and succeeded. So for me, from an LP perspective, all I really care about is the team.
Yep, that makes sense. Moving us on to the second to last question, and this is about mentors. None of us are islands. We all stand on the shoulders of giants. So who is one mentor who has contributed significantly to your career today?
I think, I don't know, Jerome Myers is a big mentor to me. He's an investor out of North Carolina, coaches a lot of different folks in a lot of ways. I love what he does. So I would say that's one mentor. Billy Keels is another great mentor who is more into real assets, oil and gas assets. But a really neat way to invest, especially if you have heavy W-2 income and you are not a real estate professional. So you can't take a lot of those losses off the real estate away from your W-2. He's got a solution for that I just love.
Cool. All right. And I lied. This is the second to last question. That one is
cool.
The third to last.
We can go. I'll take
the last question. This is about strengths. We all have strengths that we uniquely provide this world. So what is your Superman strength?
My superhero strength is the ability to take complex things, break them down into digestible concepts, and then share them with other people. Obviously, being an elementary school teacher, that is essentially the skill you need.
Up. Yeah.
Yeah. And I've really just tried to continue that skill into the insurance world, the risk management world, and the commercial real estate world.
Cool. Yep. That definitely helps because real estate is definitely confusing at times. It is not a simple thing. So if you can simplify things, that makes it a lot easier to understand. And that leads us to the final question. And this is for the listeners. You've given us a lot to think about. I'm sure people want to reach out with their insurance questions, risk management questions. What is the best way for them to get in contact with you?
Sure. So shineinsurance.com. In fact, it's shineinsurance.com/ballpark. There's a 9 yes or no question ballpark giving you a quick this is multifamily specific, but a quick multifamily insurance number for you to pencil. That's at shineinsurance.com/ballpark. Our show is called Managing Commercial Real Estate Risk, where we talk about how to, imagine this, Gabe, manage commercial real estate risk.
There you go. You heard it here. I will put those URLs in the show notes. So if y'all want to reach out to Jeremy, just click a little more in the description. It'll pull down the full description, and then there you can find his URLs. All right, Jeremy, that wraps it up. Thank you very much for hopping on the show.
It was a pleasure. Thanks so much.
Absolutely. For everybody who's here with us, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. And if you guys want to support the show, all we ask is you give us a like, subscribe, review, all that jazz. Other than that, I hope you guys have an absolutely fantastic week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.